Welcome to the Overbook Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. There's increasing evidence that we are past the point of peak inflation, peak central bank hawkishness, and peak bond yields. And of course, that is good for all asset classes. Developed markets, particularly the US, Europe, UK, are expected to go into recession this year, but the recession has been well telegraphed. The recession is likely to be mild and therefore shouldn't have a huge impact on earnings and therefore the markets. The biggest plus is that valuations are greatly reduced compared to this time last year. This time last year, valuations across most developed markets were at 2 standard deviations above the long-term mean. Inflation and interest rates were surging higher, well on the way to their highest points in 40 years. And now, of course, valuations have come down, inflation's coming down, interest rates are close to peak levels, and bond yields have stabilized. So definitely prospects for this year are much better. So let's start with JP Morgan Cazenove. Recession is a base case for the US and Europe in 2023. The recession call is a well-telegraphed one, and the contraction might not end up deep nor prolonged. Deep retrenchment or a prolonged period of balance sheet adjustment is unlikely. Strong banks' balance sheets will keep credit flowing. Money markets are now pricing a Fed funds terminal rate at 5%. So at the moment we're at 4 to 4.5%, indicating only 50 basis points before we reach a peak. Sentiment metrics are downbeat and positioning appears very light, even taking into account the recent short covering. Seasonals are favorable in the October to Feb period. And then a couple of regional calls from them which are interesting and definitely mirror the positioning in our global portfolio. So they're overweight the UK. The UK is still trading at a record discount versus other regions. It offers the highest dividend yield globally, and exporters benefit significantly from a weak GBP. Equally, overweight Japan. Japan is likely to perform better as reopening gains traction. And also the adjustment to the yield curve controlled by the Bank of Japan should usher in favorable sentiment. A weak yen is typically a tailwind for Japanese earnings and acts with a lag. So those are their 2 overweight positions. They've got 1 underweight position. Probably won't be difficult to guess what that one is. The US, which is trading at a relative PE and earnings per share high versus other markets, could lose some of the strong run that it delivered over the past 10 years. Of course, one goes underweight the US at one's peril. It always seems to surprise on the upside. Capital economics, we expect further increases in interest rates in the US, Eurozone and UK in the first half of the year, but interest rates in some emerging markets may have already peaked. And by mid-2023, we suspect rates in most developed markets will have peaked also. Most importantly, we think that the Fed may start to cut rates in the final months of the year. Emerging markets prove resilient. Fed tightening and a surging dollar have traditionally been catalysts for emerging market debt blowups. But 2022 was notable for the absence of widespread problems in emerging economies. So part of the reason for that is much lower indebtedness and certainly greatly reduced foreign or dollar-denominated debt. Emerging markets have learnt their lesson. Most of the debt has been in local currency, and emerging markets by and large have shown far more fiscal discipline than they have in the past. China, the outlook has brightened in recent weeks after the country relinquished its policy of zero COVID. China's economy should end 2023 in a much better position than it is in now. So, of course, the dividend there will be felt throughout the Far East Asia Pacific region amongst commodity producers. Therefore, many emerging markets will benefit from China's recovery. MRB, it is probable that EM currencies will broadly appreciate versus the US dollar in the year ahead. GDP growth in China, and this is MRB Partners' forecast, it's not quite as bullish as Capital Economics, but nonetheless, they believe GDP growth in China will accelerate this year from some 3% to 5%, in contrast with softening economic momentum in the US. And China's reopening will likely pull a number of closely integrated economies along with it. Moreover, commodity exporting economies in Latin America as well as South America could benefit. So cross-border capital, they're talking specifically about liquidity, global liquidity as always, and in this segment on emerging market liquidity. So I'm quoting, EM liquidity will rise strongly through 2023 due to a lower US dollar and further policy easing from China. They are bullish EM, that's the title of this long report. Emerging market liquidity rose to an index level of 43.7 at the end of December 2022. The range is from 0 to 100, more than double its recent October low of 21.5. Easing by EM central banks, notably China's People's Bank of China, played a major role, but liquidity is also being supported by continuing robust private sector inflows. Our index of PBOC liquidity jumped from a low of 28.5, again a range of 0 to 100, last May to 64.3 at the end of December 2022. We expect further Chinese policy easing over coming months as policymakers try to lift the economy out of the recent lockdowns. And of course, during the lockdown, there was very little point for much policy stimulus because there would have been little traction whilst people, consumers, were locked away. But now that they are shopping again, there'll be more traction, hence better use of that monetary stimulus. Given the importance of PBOC actions and in turn the large footprint of the Chinese economy and the world economy, investors should expect a progressive firming in commodity markets through 2023. From Neil Shearing, the group chief economist, he is turning bullish. China is shaping up to be a key macroeconomic event for 2023. The high-frequency data that we track suggests that a significant rebound is already underway. At the same time, the policy sands are shifting. In particular, the leadership's decision to step back from its 3 red lines policy. So the 3 red lines policy, you may remember, impose leveraging limits on developers. So they're stepping back from those 3 red lines policy suggests that the turn in the property sector may now come sooner than we had anticipated. We now anticipate a significant recovery in output over the coming months. We have pushed our forecast for economic growth this year from 2% to 5.5%. That is an incredible readjustment, upward surprise. And some economists are going as far as 6.5%.
Yes, Alan, it seems that 2023 could be a bit better than 2022. Statistics, the positive things, the ABSA manufacturing PMI, it came out for December, it was 53.1. It's up from the previous one's 52.6, so it's slightly up. It's important to consider that this index looks forward, so looking forward, the PMI is positive. It is a second successive month of expansion in the PMI, despite the persistent rolling blackouts. And then another positive one, our foreign exchange reserves for December. That foreign exchange reserves just means all the assets held by the SARB, the SA Reserve Bank, in foreign currencies. That foreign currencies now stands at 60.5 billion, and that's in dollars. The previous month was $59.8 billion. And this new figure of $60.5 billion is also an all-time high. And the rise was mainly due to the proceeds that was received from foreign borrowings of it was $318 million from the French Development Agency. The negatives, the manufacturing production year on year for November was minus 1.1%. That is compared to 1% positive last year. So that came down a lot. Came down from 1%. It's now at minus 1.1%. And it's mainly due to the sustained and intense power cuts. And economists, they see a 45% chance of a South African recession in this year. And they also see 85% that South Africa will land on the grey list. Locally, company news, the main company news this week was MTN. They have received a tax assessment from Uganda of $773 million. It's about 13 billion rand. It's a penalty that they must pay for because apparently they recorded their tax income too low. So that's a tax penalty that they must pay. The Ghana government issued a temporary withdrawal of the notice of assessment, and they provided a 21-day period for further engagement with MTN. The price of MTN dropped with about 6-7%, but it's up 4%, and this morning again 4%. So the market didn't take it too seriously. We was just seeing what's going to happen there. On the better side of MTN, they had exceptional results against their rivals for the infrastructure investment over the previous 5 years. They reported 1.36 million. They had 1.36 million tests to test their speed, and they were reported the best mobile operator in South Africa. So that's good. Nick, you might find this interesting. FNB's e-bucks, they were rated the best leader in the world for the use of technology with their e-bucks.